IFRS 17. The International Accounting Standards Board, or IASB, issued guidelines for a new IFRS 17 standard for insurance contracts in 2017. This is to apply to reporting periods starting on or after January 1, 2022. Implementing IFRS 17 was never going to be easy. Not only is the standard complex and some elements not yet finalized, it also requires a significant investment in both time, resources, as well as cost management. This has led many insurance companies to set up a PMO to tackle this project. Many insurers originally took a minimum compliance approach to IFRS 17, but as their programs have progressed, some realized that the scale of the change and investment required to reach the standard is much more significant than expected. In response, organizations are now looking for opportunities to not only comply, but also use their investment as a way to improve and transform their finance function to deliver real and tangible business benefits. With the final standard still to be released, insurers are still progressing their implementation projects based on the assumption of a January 1, 2022 effective date. A small number of global firms lead the pack. These leaders have already implemented their solutions to a large extent and are typically in their second or third dry run cycle. These firms will be well placed to using the remaining time to optimize internal processes and leverage the change to drive enhanced insight and business performance. More generally, across the sector, the majority of insurers are currently working through the financial impact assessment, detailed planning, and design stages of their IFRS 17 program. Their first priority is to create a target operating model, or TOM. This is a blueprint of a firm's vision that aligns operating capacities and strategic objectives and provides an overview of the core business capabilities, internal factors, and external drivers, strategic and operational levers, organizational and functional structure, technology and information resources. Using a cooking analogy, a TOM is like a recipe. You might be surprised then that more than half of insurers globally have not yet decided on their IFRS 17 TOM. Some think that perhaps you can buy an off-the-shelf solution to speed things up. And while there are definitely IFRS 17 solution vendors out there that are growing in maturity with each new release cycle, rarely do they cover all IFRS 17 needs of an insurer out of the box. Many firms that are already in the system implementation phase are finding that more work is needed than they originally expected to prepare data at the right granularity, align data models, and customize the tools and reports. As a result of this, many firms find themselves underestimating the effort required. It's therefore no surprise that for many insurers, project spending on IFRS 17 is likely to be much higher than originally estimated, and adding to the pressure not only to get the program right, but also to maximize benefits from this investment. Let's now talk about some of the key factors affecting an IFRS 17 implementation. Data and systems are at the forefront of insurers' mindsets as they tackle their approach to IFRS 17. Perhaps surprisingly though, it's usually not the calculation tools that are the biggest issue. Most firms have some form of an actuarial modeling capability which they can build on, and a number of vendor solutions exist for calculating the CSM, or contract service margin. The bigger technology challenge comes from correctly managing this highly complex and interconnected systems landscape and massive amount of data. Key challenges that companies are facing include aligning data models, managing the flow of data between all the different systems, implementing the accounting standard rules and subledgers, as well as producing the appropriate level of internal reports and external disclosures. It's already clear that not all insurers will have in place the systems and processes required by the deadline, and there are some good reasons for this. Deciding on the right IFRS 17 solution is certainly key, and it makes sense that insurers invest time to understand these specific needs in terms of CSM calculations and the accounting rules engine in particular. They then need to decide whether to build the solution in-house or whether they should select a third-party vendor and then start the process to implement and test. This all takes time, is complex, and as with any technical implementation program, there will be a shortage of available skilled resources. Therefore, it is essential that organizations plan appropriately either through upskilling their current workforce or looking to external suppliers. What is sometimes also underestimated is the talent challenge that companies will face when IFRS 17 becomes the business as usual standard. Actuaries and accountants will play different roles than they currently do in closing process, and the need for training and upskilling will only be more urgent. But fear not, there are also lessons that can be learned from successful implementation programs. First off is agility. Insurers cannot wait for all the uncertainties and unknown components of IFRS 17 to settle. And an agile approach will provide the flexibility and response to development and changes as they occur. Understanding potential risks and likely responses is key. Number 2 is to be real. Vendor solutions are never going to be fully tailored for each organization's specific circumstances. So it's important to have realistic expectations of the vendor solutions and be prepared to work with them to develop and tailor the solution for the business. That's not easy and needs careful validation. Number 3, collaboration. Given the complexity of IFRS 17, a collaborative approach is vital. In successful programs, the team supporting data, technology, vendors, the accounts, actuaries, and leadership teams all work closely together and are structured to achieve this. Optimal implementation requires all participants to understand the context around how policy decisions flow through actuarial and accounting systems, all the way to final disclosures, including data implications. IFRS 17 presents insurance companies a unique transformational opportunity. Insurers must move beyond a minimum compliance mindset and see IFRS 17 as an investment to help transform your actuarial and finance functions. It presents insurers with the chance to modernize their actuarial models and associated technologies. Some of these systems are decades old, and the speed and flexibility of technology has moved significantly in this space. IFRS 17 projects can also look into the optimization of financial close and disclosure processes, in part reflecting market pressure for earlier reporting by listed entities. It also seeks to tighten the integration of finance and actuarial activities, including the integration of data underlying actuarial and finance processes. Insurers will benefit from improved performance metrics and be able to employ new data analytics and visualization techniques to understand the key drivers for IFRS 17 and gain additional insights into business performance. So what do you think? I'd like to hear more about what you guys are experiencing in your organizations. Let me know which functional areas you cover and the biggest challenges you face in implementing IFRS 17. Please remember to hit the like and subscribe button below, and thanks for watching.